Hi everyone, this is part 2 of chapter 6 for trading price action trends. I stopped here at 2-bar reversals and variations in the first video, so I'm going to pick this one up at 3-bar reversals. A 3-bar reversal is a variation of a 2-bar reversal, but in the case of a 3-bar reversal, it's separated by an unremarkable bar in between. So a 2-bar reversal would be a bull bar and then a bear bar, whereas a 3-bar reversal would be a bull bar, a pause, or some kind of unremarkable bar, and then the bear bar. And just like a 2-bar reversal on the 5-minute chart would form a reversal bar on the 10-minute chart, a 3-bar reversal on the 5-minute chart would form a reversal bar on the 15-minute chart if the times line up. So here, for example, we have an opening reversal, high to buy around the moving average. It's a breakout of a triangle, but here we have a bear bar, so a bear breakout, and then this is the unremarkable bar. It's a pause, and that's followed by an even bigger bull breakout. So this entire complex is a 3-bar reversal. It's an attempt down, a pause, and then an attempt up. And that, on a higher time frame, forms this kind of structure. Now, in this case, the times don't line up for this to be a 15-minute reversal bar, but this is actually the story that it's telling, that it tried to go down and instead went up further than it tried to go down in this 3-bar structure. So here, that reversal structure actually led to a bull trend. Here's another situation. We have consecutive climaxes down. We had a rally in the beginning of the day, so this sell-off is probably a bear leg in a trading range, and the day should be a trading range. And so once we get consecutive climaxes down, the bears get a bear breakout, a small pause bar. This is it's a bear bar, but it's smaller, and then it's followed by a large bull bar. So this, on a higher time frame, is a reversal bar, and in this case, the times do line up. So this bar is ending exactly at 1 o'clock Eastern, and so this bar will be a reversal bar on the 15-minute chart, and that led to the rally up to the open of the day. The next major section of chapter 6 is about small bars as signal bars. The small bars are just bars that have a smaller range compared to the prior bars, but they're important because they tell us something, and they indicate a lack of enthusiasm by both sides. So for example, in a rally with bull trend bars, there's never more buyers than sellers because every transaction needs a bull and a bear, but the bulls are more aggressive. They're willing to get out of their comfort zone and buy at higher and higher prices. In this sell-off here, there are the same amount of bears and bulls during this bar, but the bears are being much more aggressive. They're willing to step out of their comfort zone and sell at lower and lower prices. So the bulls are happy to pay lower and lower prices to buy lower. But the important part about this is that the transactions keep getting lower and lower, which means the bears are being aggressive. When you have a small bar, it shows a sense of balance. That not that there are no trades taking place, but for example, in this small bar here, what it's telling us is that the bulls are not overly aggressive buying out of their comfort zone. The bears aren't overly aggressive selling out of their comfort zone, but there's more balance. There's a balanced force from the bulls and the bears. And so what gives us the information is the context. Who is currently trying to own the market and where is this small bar happening? And that's the crux of this section. So an analogy that really helped make this clear for me when I was just starting out is to think about it like a ball bouncing in slow motion. So on the way down, you'll have just one force, gravity pulling the ball down towards the floor. And as it hits the ground starts to exert its force on the ball. And there's a point right there where the force of gravity and the force from the ground are equal. They're at balance. And those opposing forces cause this squished ball appearance. And if you look at this small squished ball in isolation, you could say, well, both sides are equal, so we don't know what's going to happen next. And so you can say the same thing about a small bar, is that the small bar doesn't really tell you anything because it's just saying that the two opposing sides, the bulls and the bears, are equal. But the context can tell you everything. So knowing the context of this situation, we know it's a location where the bulls are waiting to take control because it's about to approach a floor or a support level. So when the context is supportive, balance can be a transition point from bearishness to bullishness or vice versa. And if you think about it, this is actually in line with Al's teachings about the market cycle. A bull trend typically becomes a trading range first and then reverses into a bear trend. That trading range is an area of contraction. It's an area of balance. A bear trend becomes a trading range of balance before becoming a bull trend. And this 3-bar reversal is actually a small version, a symbol of that you have a bear trend, you have balance, and then you have a bull trend. So that balance point, if the context is right, is a signal, it's a sign of something. Now, all small bars are not created equal. Some will be perfect dojis, and some will have a bullish tone with a bull body or a big tail below. And some will have a bearish tone with a big tail above or a bear body. The bar has to be interpreted in context. And so what's important with a small bar is the context and then the tone of the small bar itself. In chapter 2, I'll discuss that a doji ends a climax. So here we have a doji after a big bull bar. We have another doji after a big bull bar. So although a doji ends a climax, it doesn't mean that a reversal is coming. The context determines all of that. So the small bar has to be interpreted in context. The doji indicates a temporary balance of power. But if the context is bullish, so here we have a double bottom and then a failed breakout. So the double bottom failed breakout becomes a wedge. And now we're looking at a second leg up from this initial leg up. So the bears tried and failed, and now we have a strong breakout by the bulls and a small doji. So it's a balance of power after a really strong bull impulse. Because the context is bullish, the small bar is more likely to be a brief pause before the bulls take over again. So a small bar can act as a trend signal or a reversal signal. In a strong trend, a small bar on a pullback is only a with trend setup. It can indicate signs of weakening pressure and that the pullback may be ending. So here, the bar numbered bar 7 is a smaller bar and a smaller body. But what's the context? So that small bar and small body is showing us signs of a balance of power. But what's the context? We have a 3-bar bear breakout, which is a bear spike, which is probably going to lead to a second leg down and possibly a bear channel. And so any rally here after the 3-bar bear spike is probably a minor reversal and probably going to become a bear flag. And so when the bulls start to show signs of buying, the bears know that it's probably going to become a bear flag, and they're looking for signs of weakening buying pressure and weakening momentum by the bulls. And this small bar is a smaller bar, and the bodies are shrinking, and it's a sign that there's a balance of power in a bearish context, and so bears can start to sell. In the book, Al marks a sell below bar 7, but as he mentions later on in the chapter, buying above a doji or selling below a doji is low probability. And so if anyone's selling below bar 7, they'd have to use the correct stop above 5. And so if any trader is selling after 3 consecutive bull bars, it's best to use the stop above 5. But if they wait for the breakout pullback and then sell below 8, then they can use a tighter stop. But then he also marks bar 14. It's at the moving average. It's a small bar, so a sign of balance in a bearish context. He marks bar 17, small bar, moving average gap bar, 2 legs up in a bearish context. And then bar 21, again, it's important that these are happening after bull bars. So the bulls are trying, but once they get balanced with the bears in a bearish context, the bears take over. Here we have a big bull bar right before 17, and then we get balance in a bearish context. Here we have a bull bar, and then balance on 21 in a bearish context, and it's a sell. So all these bars that Al has marked, that I have marked here, Al has mentioned in the book as reasonable sells for bears. In the next 2 examples, the bar itself is not smaller, but the bodies are still shrinking, and that still shows a sign of a balance of power in a bearish context. So here we have a 2-bar breakout out of a trading range. And so the bears will wait again for a balance of power. And here we have shrinking bodies. So the bulls are losing momentum. And bears can start to sell. Higher probability, if they sell here, they have to use the correct stop. If they sell below the bear bar, now they can use a tighter stop. Here's another example. Same concept. Trading range, 2-bar, strong breakout, bear spike. Probably get a second leg down, maybe a bear channel. Bulls try to get the rally, probably minor reversal, probably going to become a bear flag. Once we know that it's probably going to be a bear flag, now the bears get to pick their entry based on their trading style. So shrinking bodies, some bears will start to sell this close, but because it's 3 bull bars, they're going to use the correct stop above the bear spike. Other bears will wait for the bear bar to sell below, and other bears waiting for the highest probability will wait for the bear breakout and sell below. The key point here is that the balance of power between the bulls and the bears in a bearish context is the first sign for the bears to start selling. So just like we said that in a strong trend, a small bar on a pullback is only a with trend setup, the same is true for a strong spike. In a bull spike or a bear spike, the first pullback with a small bar is only with trend. So in a bull spike, a small bar near the high of a strong bull trend bar is a very good signal bar, especially if it's an inside bar and it has a bullish tone. So right here, we have bullish tone. It's a strong 2-bar breakout, possible trend from the open. It's a small bull inside bar with a bullish tone. So that's a very good with trend signal. It's the first pullback in a bull spike. Here we have the first pullback in a bear spike. The small inside bar has a bearish tone, has a big tail on top. It's a doji, but it's the first pullback. And so it's a good with trend sell signal. When we're already 5 bars in, which I'll explain later on in the chapter, that first pullback is also a possible 1-bar final flag. So Al mentions in the book that it's better to scalp these and not swing them because we're probably going to reverse within a bar or two and at least form a trading range. So these sells below the first pullback, if it's an inside bar with a bearish tone and a bear spike, is better as a scalp. Now, a small bar can also be a reversal signal if the location and the context are right. And so that's high or low in a trading range, inside bars or small bars at extremes, and then IIs, IIIs, and IOIs. I don't talk much about these last two because Al doesn't mention them in too much detail in the chapter, but I will go over all these other ones, and you can see a brief explanation in chapter 6 about these last two, IIIs and IOIs. So first we're going to talk about small bars at extremes of large trend bars. So here we have a spike in channel. On the third push, we have a large breakout bar. It's coming after a tight trading range. So we have a tight trading range, a third push down, a large bear breakout near the bottom of a trading range day, and then a small bull inside bar. So this is buying low in a failed breakout of a tight trading range on the third push down. So it's a reasonable buy scalp above this bar with the blue arrow. It's a small inside bar as a reversal signal. Here's another example. We have a trading range day. So this context down here is the buy zone. And instead we're getting a large bear breakout into the buy zone. Now this could be a strong, successful breakout if we had consecutive bear bars closing far below the lows of the range. But instead we get a failed breakout. And so a small bar in the opposite direction after a big breakout increases the chances of a failed breakout. And because the context is good here, this is a buy above the small inside bar. Now it's not small relative to all the bars of the day, but it's small relative to the breakout bar. And so it is a reasonable inside bar reversal. Now for higher probability, bulls can start to buy above 3 consecutive bull bars, but it is a reasonable swing buy. Here's a similar concept. Here's another example. We have a trading range day, and we have a bear breakout late in a bear trend, and it's happening in the buy zone. So for bears to have this to be a successful breakout, they need a strong breakout and follow through with a lot of selling pressure. Instead, we get a bear breakout and then a bull inside bar. That bull inside bar is a sign of a potential failed breakout. And so because we're in the buy zone, the context is bullish in this area, bulls will start to buy above this bull bar. And on this day, Al did buy above this bull bar, above bar 41, and he exited half at the moving average and the other half up here. And for anyone who wants to get these examples, I highly recommend getting Al's webinar videos, his past webinar videos, because a lot of times he'll mention the trades he takes, and you'll see that the principles that he teaches in the books are the same principles he uses for these swing trades. Here's another example. We have a trading range day, clear trading range day, also an ascending triangle. We get a bull breakout, and bulls need more. They need follow through. Instead, they get a bear inside bar. Now, this isn't proof of anything. It's just a sign that the bull breakout could be failing. It increases the chances of a failed breakout. And because it's a trading range day, and it's a bear inside bar, so it's a small bar with a bearish tone, and the risk is quite small. So it's a pretty good swing trade, selling below there, betting on a failed breakout of a triangle and failed breakout of a trading range. Here's a similar example. Trading range all day, one large bar. For bulls to feel confident that this is a successful breakout, they need strong buying pressure with consecutive bull bars. Instead, they get a smaller inside bar with bearish tone. So it's a failed breakout of a triangle, failed breakout of a trading range, and the reversal bar is a bear bar, closing near its low. So bearish tone, bearish context because it's high in a trading range day and it's a failed breakout. It's a reasonable sell below. On this day, Al didn't sell below 65. He wanted higher probability. And so he waited for 2 bear bars and then sold above 66. Another example of small bars at extremes are at extremes of tight trading ranges. So here we have a tight bear channel, and then we get a strong acceleration down. This strong bear breakout is probably going to have at least a small second leg down. Now some bulls will interpret this tail here as a second leg down, and they may buy above this bull reversal bar. But if you're buying in a tight bear channel, you want to see a surprise up. Bulls who see this small bear bar will likely exit below there for a couple reasons. One is that buying in a tight bear channel is low probability, and so they'd want to see a quick move up. And two, there's a lot of overlap here, and overlap in a tight bear channel is usually a bear flag. And so bulls will know that if they're buying up here, they're possibly buying at the top of a tight bear flag, and so they'd want to see something very quick. And when they see this, a lot of bulls will exit below. A lot of bears will sell below this as well, because it's a small signal bar. It's a small bear bar at the extreme of a tight trading range. It's high in a tight trading range. So we have a bear context, tight bear channel, a tight trading range, and we're high in the tight trading range. So that's a very high probability scalp for the bears. Now it's important that bears who sell below this are scalping, because this overlap here, although overlap in a tight bear channel is probably a bear flag, it's also possibly a final flag. So bears who sell this have to know that there's a strong chance that this could be a final flag. And so they have to be scalping and not swing trading this sell. Here's another example. We have a strong bull breakout 12-13, probably going to get a second leg up. Some bears might think that this right here is a second leg up. And now we have an implied second entry sell. It's not a real second entry sell because the first one didn't trigger, but some bears might sell below there, thinking that it's a micro double top, and we've had that second leg up. If they're selling there, they're hoping for an acceleration down, because it's overlap in a tight bull channel. Overlap in a tight bull channel is probably a bull flag. And so bears who now see this bull bar, the tail here and then the bull bar here, will exit above that bull bar. And bulls will start to buy, because now we have overlap in a tight bull channel and we're low in a tight trading range. And so that's a good buy for the bulls. And so bulls who buy this are looking for a scalp to the top of the tight trading range, because they know that this is probably the second leg up from this, and that we might reverse in a bar or two. Again, another example, same concept, tight bear channel, acceleration down, implied second entry buy. Bulls want to see acceleration. Instead, they get this small bear bar at the top of a tight trading range. It's a sell below there. Definitely an exit for the bulls, but also a sell scalp for the bears. And you can see all three of these examples. It's the exact same setup, and they're all scalps. They all reverse within a bar or two. So it's very high probability, but the move is brief. And last example, which is the one that Al shows in the book itself. Implied second entry, so micro double bottom 9-10, but tight bear channel. Al argues, the explanation I gave for these three are exactly the explanation that Al gives in the book. So I'm trying to be accurate based on what Al explains. Everything I say for explanations is because either it's happened in the webinar or that Al has actually said it himself in the book. So here, bulls will exit below 11 if they bought above 10, and bears will sell for a scalp because the move down will be brief. It's possibly and maybe probably a final flag. So other areas of extremes where small bars can be good signal bars are swing highs at a bear trendline retest. So for example, this initial example in the book, Al has this trendline drawn. And so we get this bar 12, small bear bar, exact same concept. Bulls buy above an implied second entry and they get disappointed by the bear bar. It's happening at a bear trend line. So it's a minor swing high at a trend line. That's a good sell signal. It's actually better here because there's confluence with the bear trend line. And then the other example is a bull trend channel line overshoot and reversal. So when we have a bull channel and it overshoots and then reverses back into the channel, bears can sometimes use small bars as signal bars, betting that we get back to the opposite end of the channel. So for example here, we have a bull channel, a break above, and then a break back below, and then a two-legged move up to the trend line. If you have a small bar there, the context is good enough that bears can feel comfortable selling below a small bar. It doesn't have to be perfect because the context is very good. And the opposite is true for a swing low. It's either a bull trend line retest or a bear trend channel line overshoot and reversal. And finally, as I mentioned, it's better if the body is in the desired direction. So if you're looking for a buy for a continuation, it's better if the small bar has bullish tone. If you're looking for a sell, it's better if the small bar has bearish tone. If there's no body, then it's better to wait for a second entry. If there's no body, that means that it's a perfect doji. And Al mentioned some things to watch out for. Dojis are rarely good signal bars because they're one bar trading ranges, and you don't want to be buying high in a trading range or low in a trading range. So you don't want to buy above a perfect doji. You don't want to sell below a doji. But they are reasonable in certain scenarios. So reversal trades at highs or lows of trading ranges, especially if they're second entries. So because the larger trading range trumps the smaller trading range. So if we're high in an overall trading range, having a doji at the top of that as a reversal is okay because the overall context is that we're high in a trading range. So we should revert at least to the middle and with trend in strong trends at appropriate levels. So dojis can be with trend entries if the context is appropriate. So one example that Al shows in the book is right here. We have a doji, and I'll talk about this later on, but we have a doji in a bear spike. It's a possible one bar final flag, but it's a reasonable sell below because it's a bear spike and it's the first pullback. So this context, even though it's a doji, the context makes it okay. There's a special class of small bars called inside bars. I've talked about these throughout the chapter, so I'll only go over this briefly, but it's when the extremes of the small bar are contained within the extremes of the prior bar. So it's not just a small bar, but it has to be contained within the prior bar. And again, it's more reliable when the inside bar has the body in your desired direction. And so with trend inside bar increases the odds that it's a breakout pullback. So here we have a with trend inside bar. It's probably a breakout pullback for more up. Whereas a counter trend inside bar increases the odds of a failed breakout, which we talked about earlier as well. So here you have a breakout, but you have a bear inside bar. It increases the chances that it's not a breakout pullback for more up, but there's a chance that this inside bar is telling us that it's a failed breakout and that it's a reasonable swing sell, betting that it's a failed breakout of the trading range. A special class of inside bar is an II. So it's an inside bar that follows a larger inside bar. The stop placement for the II is beyond both bars. So whenever there's an II as a reversal or as a with trend entry, it's beyond both bars. So here, for example, if a bear is selling below this inside bar followed by this inside bar, which is an II sell, not a great one, but theoretically if they did sell there, their stop would be above both bars. But Al says that when an II is coming late in a trend, it's usually a final flag. And so bears have to be very quick to exit. They're only looking for a scalp. So a with trend entry with an II is usually a scalp. And in terms of management, they'll quickly tighten their stop to above the entry bar. So in the bear scenario, if they sell below the II, their initial stop's above both bars, but they'll quickly tighten their stop to above the entry bar. And then they'll manage out of the trade aggressively. So here, it's a third push down as well. So they might exit on the close of 24 or exit on the way up. But a bear who's selling an II late in a trend or a bull who's buying above an II late in a trend, like here, have to be very quick to manage the trade. And it's usually only going to be a scalp. So in this case, instead of selling below 23, the II, Al was actually talking about buying the 24 close because he knows that the II is late in the trend, so it's probably a final flag. And so he's waiting for the bears to fail. And when he sees another bear trend bar as a third push down, he's actually buying that close instead of looking to sell down here. And here, Al is actually selling above the II. It's late in a trend. It's the second leg up in a trading range day. And so Al actually sold above there, sold more higher, and scalped instead of looking to buy here. So if the context is good and the bars are good, then traders can scalp with trend with an II. But if the context is bad and the bars are bad, then traders will actually look to fade IIs late in a trend. Now, IIs can also lead to large counter trend moves. And the reason that Al talks about in the book is that IIs are, in the bull scenario, they're double bottom pullbacks. And so this II here is happening as a failed breakout of a double bottom, and it's a moving average gap bar. And so Al mentioned on this day that it's a good buy above 47. It's an II with a bull body, so it's bullish tone on the second inside bar, closing at the moving average and on its high. The reason it's a good buy is because on a lower time frame, it's a micro double bottom first, and then a rounded bottom for the pullback. So IIs in bull contexts are double bottom pullbacks. In bear contexts, they're double top pullbacks. And so there's a story within that II, the consecutive inside bars, that shows that the bulls are gaining momentum. We're getting higher lows, and the bulls are starting to take control. And that's why they can often lead to powerful counter-trend moves. In the last section of this chapter, I'm going to talk about failed reversal attempts as continuation patterns. So failed signal bars acting as continuation patterns. The first section is failed microdouble tops and microdouble bottoms. When there's a strong bear trend, for example, you'll sometimes get a microdouble bottom with identical lows and small tails below. Like this, for example. This is a 2-bar higher low microdouble bottom, but it's happening in a strong bear spike after 3 strong bear bars, breaking below a trading range. It's a failed microdouble bottom for the bulls, so bulls who are buying in here looking for a double bottom on lower time frames. If it falls below those equal lows, then it's a failed microdouble bottom, and bulls will exit below that, and bears will start to sell. So bulls who bought anticipating a successful double bottom will exit and add fuel and selling pressure for the bears. And so bears can sell below that. It's the first pullback in a bear spike, in the bear breakout, and it's an attempt by the bulls to get a bottom. So bulls exit and bears sell below that failed microdouble bottom. Here's an example I've showed multiple times, but it's a small microdouble top. And Al mentioned in the book that it doesn't have to be 2 clear tails. It just has to be 2 bars with equal highs. And if the bulls break above it, then it's a failed microdouble top. And it's a failed attempt by the bears to hold that price level, and bulls will start to buy. Here's another example. It's strong bear breakout, first pullback in a bear spike, and these are exact lows, so it's a small microdouble bottom. And when the price gets below there, bulls exit, bears sell for a scalp because it's late, so it's a possible 1-bar final flag, but still a reasonable with trend entry for the bears. And here's the example I showed earlier as well. Strong bear spike, doji, microdouble bottom, but when it fails, bears will sell below. It's the first pullback in this strong 4-bar bear spike, so bears sell below there for a scalp. Now in a strong trend, the market often will go above a bear reversal bar instead of below it. And the reason Al gives here is that there are possibly a lot of bears who are selling early, expecting the reversal bar to trigger, and they're now trapped because the bar doesn't trigger, and their stop is above the reversal bar. And so when it doesn't trigger and goes above instead, bears are trapped and they're exiting above, and bulls can buy above because it's the first pullback in a bull spike, and bears are trapped. And so bears are exiting, bulls are buying, and that causes the rally for at least a couple legs up. I think since writing the book, Al's modified his explanation of this, at least from what he talks about in the trading room, or what he's been talking about in the trading room over the past few years. Now when he talks about these situations, he often says that many bulls are buying the close of the bar so that it doesn't trigger. So he's saying that bulls know that if it triggers, it's bad for the bulls and good for the bears. And so a lot of bulls will actually buy that close as soon as it closes to protect it from going below. Either way, every bear bar in a bull trend is a pullback in a bull trend. And so this is just a pullback in a bull spike. Al gives many examples where the signal bar triggers as well and is still a good buy above. So it's not necessary that it doesn't trigger based on his explanations in the book. But I think what's important to realize for these situations is that one bear bar in a bull spike or in a bull trend is not enough to reverse a trend. So bulls should be buying where bears will be exiting. Or in other words, bulls should be buying when the pullback fails. So when we have a rally and then a pullback and it goes above, then bulls should be buying. Here we have a bull spike. In this case, it triggers, but it's a bull spike and it's the first pullback. So bulls can buy above. They're buying above the pullback in a strong bull spike, strong bull trend. And here's an example that Al gives in the book where it doesn't trigger. And he says bulls are buying during this bar 7, expecting that it'll trigger. But when it goes below it, all the bulls who are trapped exit and bears sell below. Because Al mentioned scenarios where it's a good sell below even if it does trigger, I think the easiest way to understand it is the same way I talked about the bull case. It's the first clear pullback in a strong bear spike, and so bears should be selling below when the pullback fails, regardless of if it triggers or doesn't. Now, this is also an example of a 2-bar reversal failing, but it's the same concept. It's a 2-bar reversal, but it's the first pullback in a strong bear spike. Here we have a tight bear channel, acceleration down, strong 3-bar breakout, probably going to get a second leg down, and this is a trading range, so it might fall to the bottom of that trading range. And so here we have a 2-bar reversal. It does trigger, but in this case, we get a low one sell, so bears can sell below that, or they can sell below this, below the bull bar, because it's the first pullback in a strong bear spike and bear acceleration. So probably going to get a second leg down, and this is the first pullback. So I hope that's clear. If you have any questions, please let me know. And I hope that makes sense about the bar triggering or not. I think there is some significance to bars triggering, but I think it's easier to understand it as a pullback in a bear trend or a pullback in a bull trend. I think it's important to mention that these are just the basic concepts of potential entries for bulls and bears. So we can't just find every bear reversal bar and buy above it, because there's a lot of information in the context and the structure and the approach in terms of how many legs it comes up with, what's the strength, what's the prior context. So these are just forms of entries, but the context is extremely important. So this is an example that Al gives in the book, that bulls should not be looking to buy a failure of this reversal bar, because this looks like a bull spike in the first pullback. But if you look at the internal structure, we have a big tail here on 1 and the bottom of 2, which means you already pulled back once. So it could be a spike in channel on a lower time frame. And then this bar breaks above that channel and pulls back. So it's a first breakout and failure above a tight bull channel, and then a second breakout. So this could be first leg up, second leg up. And now if you buy above this bear reversal bar, even though there are theoretically bears trapped below, you'd be buying the third push up after a micro trend channel line overshoot. So there are a lot of factors here where Al says that it's actually better to be looking or waiting to sell rather than looking to buy up here, because we already have 2 legs up, and this would be the third leg up in a possible parabolic wedge. So it's not as simple as just buying above every failed attempt by the bears or selling below every failed attempt by the bulls. But these concepts that are explained in the book, in this chapter, are tools to use when the context is right. So yeah, that's it for chapter 6. Please let me know if it made sense, if you have any comments or feedback, and I appreciate you watching.